Cool, nice to meet all of you. My name is Alexander. I am going on a vacation on Friday, and I'm going backpacking in Sri Lanka. So I'm already getting into that easy vibe, you know. And I thought we should do the same today. So please, if you have any questions or comments along the way, please just, raise your hand and let's take it in an easy and nice environment, right? Cool. Yeah, so as I said, my name is Alexander. I'm an investment manager at PreSeed Ventures. I've been there for 3.5 years now. Before that, I was a management consultant within the strategy. And I'm an engineer by education. I currently actually work with these 8 amazing startups that I also invested in. And I'm at the board of all of them, and then actively also working with them on a more weekly basis. Just really briefly around PreSeed Ventures, just so you know again who we are. Crystal already touched upon some of this, but we're an early stage investor. That means, as Crystal also said, we do tickets all the way down to 500,000, but our normal first time ticket is around 3 million Danish. So that's the pre-seed stage normally, also seed investments. We've been around for 15 years doing the same stuff. So we know a bit about it and have done many deals, as you can see. Over the last 5 years, we've invested in 150 companies, which equals over 400 founders. And over 300 million invested, right? And that's on the basis of more than 2,500 pitches we've seen. And lastly, we invest in what we call scalable companies with huge potential. So that's very broad and doesn't say much. But it's something that could become very big. I'm going to dive into this later on. But we mainly focus on the tech and software industry, also a bit in the medtech and hardware, and then on moonshots. So that's the really crazy projects that might change the world. Cool. I don't want to spend too much time on us. That's not why we're here. We're here to talk about early stage venture funding from the investor's perspective. So what I wanted to cover today was firstly, the venture capital model, so the business model behind the venture capital funds. Then what we look for in an early stage investment. And lastly, how to approach getting an early stage investment from a VC fund, right? I wanted to cover this because if you understand how we think here, why our business model is as it is, it's a lot easier to understand why we look for what we look for, something that can become very big. That's the whole unicorn thing. I'll come back to that. And then if it's still relevant, as Nicolaj said, for your company, I wanted to touch upon how you can actually approach this and get this investment. I hope that's okay with you. Cool, diving into it. First of all, Nicolaj already touched upon this, so I just wanted to point out where we are situated, kind of like in the funding journey, the typical funding path, right? So we invest all the way down from, like, not really idea, but start idea, and then all the way up to kind of like seed stage. So normally there's some angels in the case, or in the company, invested in the company already. Sometimes there's none, but we are usually the first institutional investor in. From a company's perspective, that means that you typically have the first version of a product launched. You are a couple of founders and potentially a couple of key hires as well. And you have some early traction and a bit of data on your product in the market. This, of course, differs from what you're doing and what you're building. So if you're building a security tech startup, it's very hard to get a product in the market. So that would not be applicable for that then. And if you're doing a B2C app, so an app for everybody in their phone, we would need to see a whole lot of data before we invest, right? Because some things are just easier to get to. Okay, cool, let's dive into it. So this is the business model of the venture capital funds. This is how it works. We go out and we raise money ourselves. We ask people for money. So somebody gives us a whole lot of money. We're supposed to pay them back 10 years after, and if we do good, we do a 3x on the complete amount. If you do really good, you do higher, and if you're below 1, you're not getting your second fund, even below 2. We then take this money and we invest in a lot of startups. we expect that around 1/3 of those are going to be losers. That means go bankrupt and we get nothing left, nothing back. Around 1/3 is going to pay our money back, just the investment back. And then we hope or pray that 1/3 are going to be winners. And the next things I'm going to cover is about the winners, right? Because if we look at these numbers and we look at, the slides, sorry. It says that, I just wanted to illustrate the mathematics behind it. So if you're a small venture fund and you have around 7 million euros and you use 10 million for salaries, expenses, etc., and you run for 10 years and you invest, that means you have to invest 60 millions in euros in 12 different companies. That's around 5 million per company, right? That's pretty standard for a small VC fund. That means that if 1/3 goes bankrupt, we get 0 left or back. If 1/3 just does well enough to return the funds that we invested when they exit, we only get our money back, right? And then we pray that 1/3 is doing really well. Let's say in this example that well is a 2x on the money. That means that we get 40 million back. If you add these numbers together, we're still not making money. That means, because you can't touch these, you can, the split is probably going to be around this, right? But we can't get more money on the people that go bankrupt. Whoever does well enough to just return the money, it's not going to change. But we really want to be looking for are the ones that do really well. That's why we're looking for what we call unicorns all the time, because a 2x on our money is definitely not enough. So we're always looking for this, the unicorn exits, right? And that means, first, that you need to build a really, really big company, which is valuated over $1 billion Danish, right? So that's a big company. We also need to have a lot of money, of our money, invested in it. And then lastly, we need to get it all back, right? With a 10x, which is what we normally look for. So this is just to state that what we're looking for is the unicorn exits. So we need to be looking for something that can become very, very big and very large, because otherwise our fund, the mathematics behind our funds, it just doesn't add up. So we need these huge exits in the end. Cool. That was about the VC venture model and the business model. I hope it made sense, because it's I'm going to use it in this. So building on what we are looking for, because that's how we fit into our business model, I wanted to dive into what we then look for. You can divide this up into many different ways, right? So here it's just 5 different ways that I will touch upon individually. So of course we always look at the team, also what Nicolaj was touching upon. And then we look at the market that the startup is working within. We look at the scalability of the business that you're building. We will look at the sustainable edge of your business model. And we will, of course, look at the product and the value prop. What are you presenting to the market? Cool. You're very quiet. Let me know if you... Am I talking too fast or... no, it's good? Cool. Doing good. Thank you. You know, if there's any questions, we already agreed it's a loose Wi-Fi. So just, yeah, go ahead.
What's the time horizon for the first part? What's the time horizon?
Yeah, for a venture fund, it's normally 10 years. That's what you normally do. So you invest within the first 5 years, and then you have 10 years altogether before you have to return the money. Sometimes there's a year extra or 2 years, but yeah. Cool. And sorry, Nicolaj, I'm also, there is this pitching rule, so we're supposed to do it, the questions afterwards, I know, but I like it more interactively. Okay, cool, let's dive into it. So looking at a market and looking at what we as in venture investors will look for within the market that a given startup is working at. We'll be looking at least 3 things. One is the market size and growth of the market going forward. Secondly, we'll look at the trends and the timing when you're entering the market. And lastly, we will definitely also be looking at the competition. So the market size and growth is just because, remember, you're building a unicorn. It's a lot easier to build a unicorn in a very large market than in a smaller niche market, right? And it's even easier to build a unicorn if you're building it on a market which is growing, because you're then riding with the growth of the market. so you don't need to steal as many market shares all the time. Then megatrends. If you're riding a wave of new technology or a new way of interacting with people or using new technologies, it's a lot easier to bring a company to a very, very high valuation as you're riding the trends and the timing. Lastly, competition. Who else is in the market? How many are there? And what are they doing? How well funded are they? How would they move going forward? And how are you differentiating yourself from what they do, right? So an example could be, back in the days we had an investment in Mofibo. It's that ebook thing. Back when we had the investment, the ebook market in Denmark was very small actually, but the book market was pretty big. But there's been some trends in the States showing that the ebook market was kind of skyrocketing over there. So one hypothesis could be that the ebook market in Europe is going to do the same, and it's very low penetration in Denmark. So, and there is not a lot of other competitors back then entering the EU market. So that's a valid hypothesis that there could be a big European venture case within the ebook market. Therefore, we invested in Mofibo back in the days. Cool. Products and value prop. So again, this is about building huge companies and incremental change to something that's already there is never enough to build a huge company. So what we're always looking for is a superior product, and we have a rule of thumb that says that we need something to be 10x whatever it is already. So if you can build something that which doesn't exist, super cool. If you're changing something that is already on the market, it needs to be 10x cheaper, 10x faster, or more efficient or smaller or something. So just that an incremental change is not enough to change a market and therefore make a big company. We as a company will, or as investor, will always look for the user love, right? So we want to see that that you can, so the idea is it might be easy enough to convince me that your product is super cool and I would use it, but if you can show that somebody else also thinks it, it's a lot easier to convince me, because then I don't have to trust my own gut. I can just look at all the users that I actually within your target group, right? So show some user love from the beginning, and then if you can do that by showing numbers, actual traction, that's also numbers speak. So that's also a very good thing always. If not, statements and key ambassadors and all these kind of things, they also work. So when pitching for VCs and other investors, remember to show that you have a superior product. Scalability. All right. So the idea is that we need to build that big company pretty quickly. So we need something, a company that can actually scale pretty quickly. Because if you're building $1 billion company or billion Danish kroner company, within 10 years, you need to scale pretty fast. So we always look for how scalable are your business model. 3 things that we will definitely be looking into. There's subgroups to all this, of course, but it's the organic growth, right? So if you're building a B2C, let's say an app or community or something, if you have organic growth, me sharing it with my good friend who then shares it with 2 friends and it kind of grows that way, it's just a super cheap and easy way to grow the B2C business models. So it could be illustrated by one of our investments in Tonso. It's a community app within the football youth. Another thing, repeatable sales model. This is especially also for the B2B companies, so the SaaS companies and these kind of things. We really want to see that you're not just selling to friendly customers who already know you and already bought your product just because they know you. We kind of want to see that you can show that the sales are repeatable. So if we put this amount of leads in, then we get contacted by this amount of companies, and then we close this amount of company. So have those data throughout the sales funnel. That will show that you can repeat the sales. It's just a matter of putting enough in on the top of the funnel, right? So we really will always be looking for, can you show a repeatable sales model? Another thing investors always ask about, you've probably heard it before, but the customer acquisition cost versus the lifetime value of a customer. it's just because if the mathematics, again, on a company level needs to add up, then we have another rule of thumb which says that that your lifetime value of a customer should be at least 3x of what you're paying to get that customer in, because otherwise the business model is not really scalable and it takes too much cash to build it. You also need to recuperate your investment within the customer acquisition cost within at least 12 months. We like to see less. Otherwise, you need too much cash to keep growing all the time in order to recuperate your lifetime value. That became a little nerdy, sorry, but control, know your customer acquisition costs and your lifetime values. They're going to be asked about. If you want to dive a bit into this, there is a really good Medium post on it. It gets very nerdy, so I'm not going to dive into that. But yeah, there's definitely a lot to learn there. Cool. Show scalability when you're pitching to investors, right? We want to see this stuff. Sustainable edge. Okay, so as an investor, if we believe in your idea and see that it can become a great success, we also want to see how you're going to defend this. Because if you're building something that can easily be copied, there's always somebody who's moves faster or has more money, and can just do it if there's no moat to defend your company. So what we're looking for is a sustainable edge, something that when you become a success, it's going to make it difficult for the next one to just copy what you're doing. There's a lot of classics on this, IP being one of them, high switching cost, usually also one of them, economics of scale, just because you're big, it becomes easier and cheaper and you can deliver cheaper. Branding is also in some fields a huge thing. What we also always or often see within the tech and software industry is what we call network effects. So it's where your product becomes better the more customers or data you have in. So the larger your network is, the better the product is. So for example, for Facebook, it's very easy, right? Because their network is huge. So trying to compete with Facebook and start one new network, the first customer in will have zero value out of it, right? And Facebook's is so huge, so it's difficult to copy. But you can also do this on two-sided marketplaces. The more you get in, the more value there will be. So it's the seller and buyer. The more buyers in there, the more sellers will get in there, and then again, the more buyers will come in. So all these two-sided marketplaces is also very good with the network effects. And lastly, AI and machine learning and all these is becoming a big thing. So the very data-heavy products that rely on, or data-heavy startups that rely a lot on software, there's also a sustainable edge in your AI will actually, or your data, the machine that reads the data, will become better and better the more data you have. That means if you land a new customer and a new data set, your product will become better and it will be easier to get the next customer again. So this is a typical sustainable edge, especially in the more heavier tech startups. Cool. So just to sum up on that one, when pitching investors, please show that there's some way of defending your business going forward if you are to become a success. All right, cool. Last one, but the most important, especially at our stage, team. So our number one factor when evaluating startup is team. So it counts for the most. And it's a little hard to put on words. All the other stuff is easy because there's different recipes for it on how you do it. But the team is, it's a lot of a stomach feeling, of course, right? But I'll try to say what we look for. What we look for is somebody who's purpose-driven, so has a big vision and is not afraid to go for it. Not a true ambassador for the startup or the product. Somebody that actually thinks that if this is to become a reality, it can change the world or it will make a huge impact. So we need somebody who's purpose-driven and has a huge vision and can sell that vision to other people as well to get them on board on the team. Then we need, or we would like to see some complementary skills. So a one-man band is always a little difficult to invest in. So we normally see a couple of co-founders, and ideally they have a bit of a different skills. So there might be somebody who can build the product, there might be somebody who can sell the product, and there might be somebody who can do the strategy work on it. So just all these different skill sets that they're not too overlapping. So 3 CBS students, sorry if there's any, sitting in a room, coming up with great business ideas is never going to ship a product, right? Because they are never going to build it. And 3 engineers just sitting around and building a product is never going to be able to sell it because they won't open the door. So try to get those complementary skills in the team. Hopefully the founder team as well. And then execution. This is we need to see that people are moving, right? And moving forward all the time. And there's going to be a whole lot about obstacles in your journey. So we need to see you move around them. And if you just go the normal way, it's definitely been tried before. So we need to see people being innovative in getting to the end point. How do you get through the barriers? How do you execute? How do you do what hasn't been done before? So kind of showing that, fire or a will to kind of overcome what hasn't been done before, and the barriers that are the reason it hasn't been done before. Yeah, it's the very vague thing. I'm sorry, but it's a bit on the team. Cool. So that will be our number 1 thing when evaluating a startup. Of course, all the other stuff also matters a whole lot, but the team are who we invest in. Cool. So summing up on point number 2, how am I doing on time? I'm okay. We look for things that can become huge because that's necessary for our business model to fit together. That means that we, in the market, scalability, value prop, sustainable edge, and team, look for certain things, something that can grow and become really big in not that many years. If venture funding and this venture funding journey is still relevant for your startup, I thought I would quickly touch upon how to actually approach getting an investment, right? So how do you get an investment from us or any other fund? Cool. So I wrote down some points. And whenever you do a list, there's always something missing, right? Or a point too much. So this is just an arbitrary list of different points. There could be others. There's probably too many as well. But just to say, it's not the set in stone. This list it's just to be a talking platter for me. So let's say you're over here and you need funding, and you want to go over there, where you secured some funding from an investor or a VC. Some of the steps that I would definitely go at what? Number 1, get to know the VC model, shortlist your targets, create the pitch material and train introductions, get the introductions to the people, create interest, create momentum, close term sheet, due diligence, keep momentum, and then funding. I'm going to dive into them a little bit. So first of all, we already touched a bit about the VC model today. There are multiple sources online out there and books on it. It's just to understand who you're dealing with makes it a lot easier to cater and say what they want to hear. So understand who your investor are. Also, as Nicolaj was talking about, right? If it's the business angel who is investing with their heart, talk to that heart. If it's the VCs like us, you got to show the other stuff probably also at a business angel. But we want to see something that can become really big and a credible plan for getting there. So get to know the VC model and how we work. Then shortlist your targets. I got this email the other day. Mining company in China seeking investment. We don't invest in mining, and we definitely do not also invest in China. So it's not really relevant for us. The idea is that all VC funds, as Nicolaj was also talking about out there, it's all they all have stage focuses. They have geography focus. There's also a lot of models and focus areas they like to invest in. We are pretty broad, but some investors are only investing in SaaS companies or only in medtech companies. So get to know your investors and find the right targets for you. The whole idea is also don't waste time on anybody who's not within your target group. Because they might end up wasting time with you guys just to hear more, get you whatever's happening in Denmark within this little eco field. So yeah, you could end up spending a lot of time on people who are not relevant. Cool, moving on. Create material and practice. Again, pitch decks and all this stuff, there's tons of resources online where you can read more about it, so I'm not going to dive into it today. What I really wanted to highlight is that we always get a lot of pitch decks saying, oh, we're raising 30 million, do you want to invest? And we're like, oh, yeah, okay, but what are you gonna, how will you spend the money? How much runway will it give you? Where are you gonna be when once you've invested, once you used our funds? Will it be enough to get to the next stage funding so that another fund will come and invest after us? So we're actually more interested in this than the exact amount, right? So it's tell us more than just that you are fundraising a certain amount. Cool. Moving on. Yeah, introductions. So again, I had this other email the other day. Somebody's shotgunning their pitch deck, right? So just, this is all the investors in Europe. I can find them on Techstars a VC list. I'll just email all of them, right? It doesn't work. It really doesn't work. We as investors, we want to feel special. It's a little bit like a dating game a bit, So if you know somebody or play it that way, just be nice about it. So don't shotgun, get introductions. If you can get a warm introduction, it's by far the best, right? So use your network, other founders, earlier founders, even uncles or whoever. Just try to get that introduction, warm introduction, because it's just going to make life a lot easier to get to that first meeting, actually. If you can't get a warm introduction, we at PreSeed Ventures, we also do, we have an inbound flow as well. And we do actually look at them and evaluate all the pitch decks. So there are other ways of doing it if you don't have the network to get the warm introductions. But it's by far the best. All right. Cool. Then create interest and build relationship. The whole idea is that there's Mark Suster, and a US investor who said it very well, I think. He said, create lines, not dots, right? So the idea is we always meet these teams and they say, we're here today, don't you want to invest? And the idea is that we really actually want to get to know the people, see how they're doing, and moving forward. So yes, these drawings I really like. The idea is that the first time we meet, you're only a single data point. It's just a dot within performance and time. I have no idea if you're actually moving up or down, or if you used to be up and now your company's doing worse. So we want to follow the company for a while. We want to make lines and create that idea that you're moving forward in the right direction. The whole idea is so you meet the first time, then you say, next time we're going to be here. And then follow up next time and write me, hey, now we met this and this key KPI that we agreed on. We thought it was cool. And then create those lines, because investors, they invest in lines and not in single data points. So don't wait until you are running out of cash as well, because you need to build a bit of rapport and a relationship with your investors. The rest I'm going to do fairly quickly because I'm running out of time. Also, I thought these are, if you get to this place, you're doing pretty well. Then read the rest of the material and dive into the points. But the whole idea is, so you got an investor interested and you're building the lines. Don't stop. Of course, it makes sense, but create momentum towards that end goal. So at some point you got to bring in, we also racing. Do you want to join in? Now this investor said yes, or this investor said yes, or we got this inner booster kind of thing. So create that momentum in the end. And then the next step is hopefully going to be a term sheet. The term sheets we covered in the legal aspects a while ago, but that's the document that illustrates how the investor actually wants to invest in your startup, right? So when you get to the term sheet, you're doing well. You're doing pretty well. Then all this due diligence and legal aspects stops. That is the investor double checking that they want to do the investment, and also that they can get that you can agree on a legal deal. Don't lose momentum there. That's the last point. Don't lose momentum there, because it gets a little bit boring. Sorry, our lawyer is sitting over there, but it gets a little boring with all the legal stuff and all the documents and all the due diligence and the financial reporting and everything. But if you lose momentum there, there's always a chance that the deal might collapse, right? So keep up the momentum, and hopefully in the end, there'll be a funding event from a VC. Cool. That was all for me.
So, valuation, I guess maybe that's good, both of us. Then I'll just start.
Go ahead.
So, valuation is really hard because in the beginning when I invest, that's really, really early. Anyone who make a net present value calculation will laugh, right? Because I can get any startup with euros to be either worth 0 or 100 million, right? So what determines valuation is, of course, a little bit about our rule of thumb. So when I see 100 deals a year, I know sort of I have my own say what a fair price is. So in my view, something, if this deal is interesting, that's the first thing we discuss. So we don't start discussing valuation, we start discussing, is it really interesting? Then if it's interesting, I have this gut feeling what a fair price might be. And then to get me out of that range, you really have to be special. So if I give one example, I invested in Stefan Alstrup, the deal professor startup, and I invested in a valuation that was twice as high as I normally do. Despite it didn't have really that traction. Why? Because Stefan has basically attracted the 4 or 5 of the coolest machine learning persons I have heard of in Denmark to go into that startup. Right? So it's about storytelling, but it's of course also about sort of the rule of thumb. So that's how I see it from an angel perspective. I don't know about you.
Yeah, I totally agree. So it's always about the love as well, as you were mentioning. Then there's of course tons of way of actually evaluating a given company, and they matter to a certain degree. Then also worth pointing out, if there's competition of doing the deal, it's just going to raise the prices, as it always does. So if you have multiple term sheets or multiple investors interested, being a bit stupid now, I know, but yeah, get multiple investors at the same time, then you can get the deal up as well. And also, as you were talking about, there's a lot of data online actually also about the prices. And there's on Virk, there's also a place called Indjørningbot in Danish. They list all the valuations of all startup companies done out of Denmark. So there's a good idea to kind of get your range and whatever valuations are out there.
Maybe actually you could then start with what should you as a founder look for in an investor, right? So basically the investors will do their due diligence. So when you are in this fantastic lucky position that you have 3 different potential investors, what should you be aware of?
Yeah, so I'm a very person-driven person, so I would definitely put that as number 1. You're going to be half marrying these. Your startup is going to be marrying that investor, so you need that marriage to work. So you need to be able to interact and respect the person, and have a good feeling. So just that feeling about that the collaboration is going to be well going forward, both when things are well, when you're funding, but also when things get a little hard. So we'll definitely go for that. Then of course there's a lot of other stuff on how's their network, how much value add are they providing along with the investment, have they had previous successes, how long around in their fund are they, and there's a lot of stuff. But I would go for the hard thing. Sorry.
I think the easiest thing you can actually do is to go to some of these companies that investors have invested in before. So I think the most professional startup I see do this is when I invested in Pento, which is a salary management software where you also investor. Yes, you also investor. We have invested a lot together. And basically the founder, he basically said, Nicolaj, can I talk to some of the CEOs from some of your companies? And I said, yes, just call them. Can you imagine if I said no? Right? And you should do the same. So when you're in dialogue with a business angel, you should basically go into that business angel's LinkedIn profile and say, hey, you have invested in XYZ. Don't ask the business angel for permission, just call. And if these founders, which they normally would do on the phone, give a very honest opinion, it will be harder to get on writing, but just have it on the phone. And if you hear something bad, I think that's a good sign of walking away. So when does it make more sense to bootstrap? I think you should bootstrap as long as you can. Because then you bring value and you'll have better deals, you'll have better investors. And it's really hard to find the founders who said in hindsight, oh, I should have taken money in early. It's just hard. So you should come and I think all of us investors agree on that you should come as far as you can. And then you should take investors in if you can make a significant difference. So basically saying, hey, I have this ad and I can only succeed in the market if I get 5 million kroner, right? But if it's about getting a little bit better traction, then I wouldn't do it. I think that's enough.
Yeah, I have to disagree a little bit, of course. No, but it makes sense. I think when you're starting a business, at some point you feel that if you just had that extra cash, things would move a lot faster, and that's why it makes sense starting to look into taking in an investment. But in the beginning, in the early days, and when you're just figuring out what you're actually doing, I think I would bootstrap a bit as well. Cool. Next one. How to become friends with business angels, maybe also investors. Events like this is a very good place, say hi. Do not pitch your whole pitch to me and Nicolaj tonight because it's going to take too long. But but come up and say hi, can I drop you an email? Or there's multiple ways of doing it, right? So get events and also, again, the warm introductions from others.
Yeah, and then we're coming back to this point about most of us, we invest so early. So yes, we can have all our rankings of how cool your business model is or whatever, but in reality, most of that comes down to this gut feeling. So you could score really, really high, and then behind closed doors, we'll just sit down and say, yeah, but something doesn't feel right. So it's really about this personal chemistry, and also about that we will, like you'll be sitting and saying, hey, we're managing these guys. We will say the same. Say, do I think it would be fun to work with these when it's getting tough? And that's really about. So a good thing is start by just meeting people, right? It's really, that's also why I sort of have this love-hate relationship to Dragon's Den, Løve's, because some believe that they get the money after 10 minutes. They don't. I think the average for you will maybe be 3-4 months. I don't know. For an angel, it will easily be 1 to 2 months. Not because the paperwork will take that time, but because we want to know who are we investing in. Right. So how long will it take? I'll say, if it's a person I never met before, so I have to do this checkup myself, I would say 1 to 3 months. If it's a person I know well, and the person says, there's this round, they will like, you can be part of it. It's basically a few phone calls. So that was Stefan Alstrup. He didn't have any investment material, but I knew him from a friend, and I was standing in the airport, and I asked for investment material. He just said, Nicolaj, I don't use investment material. So, but that was also strange because I know him from the past, right? But normally 1 to 2 months.
So when you're a fund, it takes a little longer. We can't just shoot from the heart. We have a process for it. But if you already created that line, and that might take a month, or it might take a couple of months, but if you already created that line of showing your performance and that we want to do an investment, from actually doing the term sheet to the money is in the account, if we're really fast, it takes a month. Normally it's around 2 months.
So take the next one.
Prototype stage, you validate the idea how much equity scale will make the first investment. So it depends, right? So if you bootstrap it a long time, it's easier to get a high valuation and stuff. I don't know. Yeah, you got an idea.
No, it's just. Yeah. I think the old rule of thumb was 20% in each stage. That was the old rule of thumb. But the problem is, again, how much do you need? Because you might come to this stage, you've bootstrapped so far, and then you say to an angel, hey, we exit to the next value inflection point. We don't want this extra money, we only want 300,000 kroner. So it's really hard. I would say, maybe I would more say, the average valuation I see in this point in time is maybe this 10 million-ish, something like that. Yeah, and then it depends on how much money you're raising. Are you raising 2 million, are you raising half a million? Does exit strategy play a role when you invest? Honestly, I don't believe in whatever you write on that slide, because it's 10 years from now. It's a dream, and the dream is great. It maybe says a little bit about you, what you want to do. I don't put too much. I think I do my own thoughts about, could this be something that is worth so much for someone to buy at some point in time? But these logos out there, I don't really put that much value on.
So we do care about it. It's definitely not the first point on the list. It might be all the way down on 10th or 15th. But it's always nice with an idea of how can we at some point exit this. And there's a credible idea, just not on the logos, but maybe just on which area, who would pay for this in the end. later stage funds will of course put more value into it because they're sooner for the exit, right? If we want a VC investment, should we first commercialize an MVP with a limited market, or should we go for the grand vision with a big market? We've done a fair bit So then we have the saying that we'd actually like to see you succeed in Denmark before, and then go for the grand vision, abroad, Europe, or go international. The idea is that you can do a bit of the stupid mistakes in Denmark, and then learn from that, and then execute easier on the more grand vision. I think that's what might be meant with this question. So I would try out with a smaller beachhead market that doesn't mean that much if you're learning while you're doing it, and then commercialize the grand vision. I don't know if you have any comments?
I have to agree on that, because it's just really hard. No one would give you enough money for the grand vision anyways. So then there'll just be another big segment where there will be France or whatever. And again, you're going for the market where you have the biggest chance of success, and that's most likely the one where you have the personal connections and whatever. And if you come to a Danish VC and say, hey, Nicolaj, I have this will become big in Spain. Have you tried in Denmark? No, but it will become big in Spain. They will never. But it could be that when you become big in Denmark or the Nordics, that they will participate in a round for Europe or Spain. So I think we take 2 more questions, and then we take the food. How do you become business angel with no money? That's actually how I started. I had no money. That's called sweat equity. So I worked 3 years with, 4 years maybe, with consulting. So I did 2 or 3 days a week where I did consulting, just because I need money. Those consulting money I spent on investing in startups, but also that I could go to startups and say, hey, you're 2 great engineers. I can help you with X, Y, Z, and then basically work for free. That's how I started.
Yeah, so I'm not a business angel. So, what Nicolaj said, I think it sounds like a good idea. We do see these sweat equity deals once in a while out there. As a startup, you shouldn't bring too much equity in that way, but it makes a lot of sense, especially if the people can actually help you along with the journey.
And that maybe leads to the final one. And I think if there's one thing you need to remember whenever you make an agreement with someone here for a partner, that is basically that your payment, in this case equity or warrants, are vested over time. Right? So I made an agreement with Alexander. Alexander said to my startup, I'm great at XYZ. And we agreed that he should then earn 10% of the company. That 10% of the company should be vested over a long time. That could be maybe 4 years or something like that. So if after 1 year we agree that we shouldn't be married anymore, well, basically you will have a fair share of work, but that's it. I think that's basically to avoid this term debt equity, which Alexander also means.
Yeah, so I totally agree. It also depends on what you want. Whoever asked the question, also what you want out of it, right? So if you're looking for money at the beginning, or if you have the patience to actually go further with the startup, right? So because it's first the shares are first going to be worth something in many years from now.
Cool.
Yeah.
So we take the 15-minute beer break and snack break now.